For decades, national wealth was pulled from the earth. Tomorrow, it will be calculated on servers. But for Cyprus, making that jump requires an initial, massive injection of physical capital. Underneath the eastern Mediterranean, drill ships are mapping a massive energy reserve. The Aphrodite and Kronos discoveries sit on an estimated 50 trillion cubic feet of natural gas. Teams on these offshore platforms are targeting first gas production between 2025 and 2028. Based on current average wellhead prices, tapping those reserves gives the Cypriot government a projected annual income of 1.75 billion euros. Selling fossil fuels is a temporary windfall, not an endgame. Cyprus is positioning this multi-billion euro payout as the seed money to build an entirely different type of economy. Before any of that new money can be invested, the government has to clear the heavy financial burdens of the past. A decade ago, financial instability forced deep cuts to public services and provident funds. That projected 1.75 billion euros a year changes the math entirely. It provides enough incoming revenue to close the national budget deficit and pay down existing sovereign debt in just 5 years. The recovery is already visible. Strong fiscal surpluses have pushed public debt down to 55% of GDP, officially dropping below the European Union's 60% Maastricht Treaty threshold. Dropping below that 60% mark activates a critical legal trigger. It means future hydrocarbon profits no longer have to be diverted to mandatory debt repayment. The state can route that cash directly into long-term investment reserves. Beating the Maastricht threshold converts the offshore gas from a necessary survival tool into the foundation for permanent, compounding state capital. With the debt constraints removed, that newfound fiscal space is coming ashore, where it is being directed toward hyper-efficient computational infrastructure. Coastal hubs like Larnaca are the prime targets for a network of medium to extra-large AI data centers, ranging from 20 to 100 megawatts in capacity. This chart shows the power consumption breakdown. At the 100 megawatt column, the energy load for grid-scale AI is massive. Direct seawater cooling shrinks the top orange block, the chillers, reducing cooling energy by 10 to 15% versus inland facilities. That geographic optimization drives highly competitive power usage effectiveness. For institutional investors, it translates to an aggressive payback period of just 1.8 years on a 100 megawatt build. Server racks and chillers only generate returns if they have something to process. Physical AI infrastructure requires massive amounts of structured, high-quality information to function. The Republic of Cyprus has already built that software foundation. Its national open data portal currently houses over 1,900 distinct datasets, actively aggregating information from 94 different public organizations. The European Union's latest Open Data Maturity Assessment ranks Cyprus 8th among member states. The country achieved an overall maturity of 94.6% and a flawless 100% impact score for effectively translating data into societal use. Deep integration of public API data gives developers exactly what they need to train new models, streamline urban mobility, and attract specialized tech spin-offs. Pairing grid-scale AI compute with top-tier data maturity creates an economic multiplier. The hardware processes the data improves the public sector, and the combined system accelerates the nation's total economic output. To capture and protect the returns from both the ocean floor and the server racks, Cyprus is designing a specialized dual-engine sovereign wealth framework. The first component is the Energy Fund. Its entire job is to absorb the volatile offshore gas royalties and keep them completely insulated from the daily state operating budget. The second is the Data, IP, and AI Fund. This arm targets digital technology revenues, acting as a high-reward counterweight to the legacy fossil fuel sector. Operating under a permanent income hypothesis, the combined funds invest their capital into global markets. The interest and dividends earned offshore create a stable, continuous cash flow back to the state. This structure effectively removes the state's reliance on fluctuating commodity prices and domestic taxes, securing the country's long-term economic stability. Macroeconomic theory only matters if it impacts the people living inside the economy. We can map exactly what this combined wealth mechanism looks like over a 30-year timeline. With a 4% return and commercial gas starting soon, models project the combined funds could reach 16.9 billion euros. A conservative 3% annual payout safely distributes €508 million every year without depleting the principal. If that annual yield is split down the middle, half goes directly to general budget support, while the other half is distributed directly to the public. That equals a projected €511 direct annual dividend for every citizen. Extracting gas from the ocean and processing data on the coast ultimately builds a financial engine designed to fully fund the future of its people.